It sounds like a tax dodge, but it is the legal formula billionaires have used for a century. They buy appreciating assets, they borrow millions against those assets, they die, and they leave behind no tax bill. They pay half the tax rate of a school teacher, all by playing a rigged game hidden in plain sight. Why does this buy, borrow, die system exist, and how does it keep getting bigger? For most people, wealth comes in the form of a paycheck. Wages hit the bank account and taxes hit just as fast. Every dollar earned is shaved down by the IRS before it is even spent. But for the ultra-rich, the game starts with a different move. They buy assets that grow in value, stocks, real estate, even fine art. These are not just investments, they are shields. As long as these assets are not sold, all of their growth sits untouched by taxes. This is the concept of unrealized gains. The law says you do not owe a cent on the rising value of your holdings until the moment you sell. So while a teacher pays taxes on every paycheck, a billionaire can watch a portfolio balloon by millions and report almost nothing as income. Consider the numbers. In the last decade, the S&P 500 averaged around 8% annual growth. A $10 million stock portfolio could quietly double without triggering a single tax bill. Meanwhile, the median American household earning $70,000 hands over about $10,000 in federal income taxes each year. The rich, by contrast, accumulate wealth tax-free year after year, just by holding rather than selling. The IRS cannot touch what has not been cashed in. This is the hidden engine behind dynastic fortunes. Buy appreciating assets, let them grow, and never let the taxman in the door. But what happens when the rich want to spend without selling? That is where the next step in the formula comes into play. Unlocking cash without selling is where the machinery of private banking comes into play. For the ultra-wealthy, spending big does not mean liquidating assets and paying taxes. Instead, they walk into their bank and request a securities-based line of credit called SBLOC. This is not a payday loan or a mortgage. It is a custom credit line backed by a stock portfolio, real estate, or even art. The bank reviews the value of the assets, often allowing clients to borrow up to 70% of the portfolio's worth. If someone holds $10 million in stocks, they can access $7 million in cash without selling a single share. Here is the catch. Borrowed money is not income. The IRS does not count it as earnings, so no tax bill lands in the mailbox. The rich can use these funds for anything, including luxury homes, private jets, business ventures, even paying taxes on other income. Meanwhile, their portfolio stays intact, continuing to appreciate. Banks compete for these clients, offering low interest rates, sometimes as little as 1% for the biggest fortunes. Repayment terms can be flexible, with interest accruing year after year. As long as the underlying assets hold their value, the cash keeps flowing and the tax collector stays locked out. This is how fortunes become spendable without ever triggering a taxable event. The numbers behind this trick come alive in real-world examples, but the structure itself is the silent engine powering lavish lifestyles. Maria sits on a $2 million investment portfolio. Half of that, $1 million, is pure gain. She wants to unlock cash, but the path she chooses changes everything. If Maria sells her assets, the IRS steps in. The 20% capital gains tax, plus the 3.8% net investment income tax, means she hands over more than $250,000 to the government right away. Her portfolio shrinks, and so does her future earning power. But Maria has another option. Maria borrows $1.4 million against her portfolio instead. The bank is happy to lend. Her stocks are solid collateral. The interest rate is 6.5%, so she pays $91,000 a year to service the loan. Here is the catch: that borrowed money is not taxable income. No tax bill arrives. Maria keeps her portfolio intact and it keeps growing. At an average 8% annual return, her $2 million generates $160,000 in new wealth that year, more than enough to cover the interest. After paying the bank, she is still up $69,000 with her original assets untouched. The difference is stark. Selling triggers a $250,000 tax hit. Borrowing costs less than half as much, and Maria's investments keep compounding. This is not just clever accounting. It is the math that lets fortunes grow tax-free, while regular earners watch their paychecks shrink. What happens to that deferred tax bill? For Maria, the answer comes at the end of the line. Death is where the tax bill, deferred for decades, quietly disappears. Under the United States Tax Code, specifically Section 1014, assets passed to heirs receive a stepped-up basis. That means the cost basis resets to the fair market value on the day the owner dies. Any appreciation during the owner's lifetime, no matter how large, is wiped away. Heirs inherit stock, real estate, or art as if they bought it at today's price. If they sell immediately, there is no capital gains tax owed. Decades of growth erased from the government's ledger in an instant. This reset does not apply to everything. Retirement accounts like IRAS 401k accounts and annuities do not get this treatment. Those taxes still come due. But for the bulk of dynastic wealth, stocks, real estate, and family businesses, the stepped-up basis is the golden ticket. In community property states, married couples can receive a double stepped-up basis, resetting value for both spouses' shares at each death, compounding the effect. The machinery goes further with dynasty trusts. These are legal structures built to last for generations, often set up in states like Delaware or South Dakota, where trusts can run for centuries. Assets held inside can receive a stepped-up basis at each generational death, letting families recycle the same wealth tax free again and again. Loans taken out during life are repaid from the estate, usually by selling a portion of the newly tax-free assets. The rest stays with the heirs, untouched by the taxes that would have applied to any regular person. The cycle is complete. The tax bill vanishes, the fortune survives, and the next generation is ready to play the same game. In 2021, a leak of IRS records shattered the illusion that the tax system treats everyone equally. The data exposed the real numbers behind America's wealthiest families. Over a 5-year span, the top 25 billionaires paid an effective federal income tax rate of just 3.4%. That is not a typo. For comparison, the average American household paid 14% over the same period. Names like Jeff Bezos, Elon Musk, and Warren Buffett appeared in the documents. Men whose fortunes ballooned by billions while their tax bills barely budged. The mechanism was simple. Their wealth grew on paper, but because they did not sell, almost none of it counted as income. Loans filled the gap, letting them spend freely without triggering taxes. The numbers left little doubt the richest Americans live under a different set of rules, and the gap is not an accident, it is built into the code. While most Americans debate tweaks to income tax brackets, the real action happens far from the spotlight. For the ultra-wealthy, discussions about raising or lowering tax rates are background noise. They simply do not show up on the radar. Their wealth is not counted as income, so the headline battles in Congress do not touch them. The system's design lets fortunes compound, untouched, while regular workers fund the roads, schools, and safety nets everyone relies on. Public outrage sometimes sparks calls for reform, but attempts to close these loopholes rarely survive the lobbying onslaught. Even when Congress approved $80 billion in new IRS funding to target high wealth audits, the agency has struggled to keep up. The richest households can afford teams of lawyers and accountants, while the IRS, after years of budget cuts, is still playing catch-up. The rules have not changed. The game remains rigged. Until the core mechanics are rewritten, the tax code will keep rewarding those who know how to sidestep it. Today, the tax code rewards ownership, not wages. As wealth inequality accelerates, the legal gap between how assets and labour are taxed shapes who pays for society and who does not. The rules are not broken. They are built this way, so the question remains, who gets to rewrite them? Share your thoughts below.